Silver fell 16% in a single day, not over months, not after a slow deterioration, in hours. And what's strange isn't just the size of the drop, it's when it happened. This came after a 2-day rebound, after headlines declaring the worst might be over, after silver had already crashed nearly 30% the previous Friday. At around 8:30 a.m. Eastern, spot silver was trading near $77 an ounce. Futures were even lower. Gold, by comparison, barely flinched, down about 2%. That gap matters. Because when silver collapses this hard while gold stays relatively composed, something very specific is happening under the surface. And most people missed it. I've been watching precious metals long enough to know this pattern rarely announces itself clearly. It usually hides behind words like volatility or technical correction. But this move didn't feel technical. It felt mechanical. And once you slow it down, step by step, it starts to look less like a normal sell-off and more like a structure breaking under its own weight. Let's walk through what actually happened. Facts only. No theories yet. Silver had been on a historic run. In 2025 alone, prices were up roughly 146%. That's not a typo. One of the strongest annual performances in modern precious metals history. Then came the reversal. Last Friday, silver dropped almost 30%. That alone should have reset expectations. Markets don't usually absorb a move like that and immediately stabilize. Yet, over the next 2 days, prices bounced. That bounce pulled people back in. Then, Thursday happened. Silver slid as much as 16% intraday. Spot prices were down nearly 12% at the lows. Futures followed closely behind. Gold declined too, but only modestly. So this wasn't a broad precious metals panic. It was silver specific. And analysts were quick to point out why. According to multiple desks, this wasn't driven by collapsing physical demand. Not solar, not electronics, not industrial use. It was flows. Speculative flows, leveraged positioning, options-driven trading. In other words, paper silver. Sunil Garg from Lighthouse Canton put it bluntly. Speculator positions had built up aggressively, and in his words, they hadn't been fully flushed out yet. That's an important phrase. Not fully flushed out. Because it suggests this move wasn't random. It was part of a process. Here's where it gets unusual. Silver is volatile. Everyone knows that. It's thinner than gold, more industrial, more sensitive to cycles. But this correction was far larger than gold's. Gold slipped about 2%. Silver collapsed. Why? Goldman Sachs pointed to liquidity conditions in the London market. Tighter liquidity means price moves don't get absorbed smoothly. They get amplified. But that's only part of it. The deeper issue was positioning. As prices fell, dealer hedging behavior flipped. Instead of buying into strength, which stabilizes prices, dealers began selling into weakness. At the same time, investor stop losses were triggered. Forced selling meant falling prices. Losses cascaded. That word matters too. Cascaded. Because cascades don't stop when the first seller is done. They keep going until something breaks the chain. And this is where margin comes in. Following the initial sell-off last Friday, metals exchanges began raising margin requirements. The CME group confirmed it. Higher margins mean traders need more cash to hold the same position. If they can't post it, they're forced to exit. That doesn't ask whether you're right long term. It doesn't care about fundamentals, it's binary. Pay up or sell. So when margins rise into falling prices, the effect is predictable. Speculation gets killed, not gently, not selectively, it gets wiped out. And that's exactly what Garg suggested might still be underway. Now, pause here, because this is the moment where narratives usually start to drift. Some people immediately jump to manipulation. Others claim it proves silver was never real value to begin with. Neither conclusion is supported by the facts we have. What is supported is this. The price action was dominated by leveraged paper flows, not physical demand. That distinction matters, because it changes how you interpret both the crash and what might come next. Another detail deserves attention. Goldman noted that the timing of the most violent moves suggested Western flows, not Chinese speculation, were behind the buildup and the unwind. Why does that matter? Because during many of the sharpest moves, Chinese futures markets were closed, which means this wasn't a Shanghai-driven frenzy. It was largely Western positioning unwinding in real time. That narrows the field, and it also challenges one of the most common assumptions people make during commodity spikes, that Asia did it. In this case, the data doesn't support that. Then came the comparisons. Market watchers began likening silver's behavior to meme stocks, most notably GameStop in 2021. That comparison isn't about asset class, it's about behavior. Prices detached from traditional valuation anchors. Momentum traders piled in. Volatility fed more volatility. Steve Sosnick from Interactive Brokers described it as momentum trading that exceeded even the outsized moves seen in other speculative assets. That's a strong statement. especially when it comes from someone who has watched everything from tech bubbles to crypto cycles unfold in real time. Now, let's slow this down. Silver is not a meme stock. It has real industrial uses: solar panels, electronics, catalysts, medical applications. Those fundamentals didn't disappear overnight, which raises the central tension of this entire episode. If the fundamental case still holds, and most analysts agree it does, then why did price collapse so violently? And more importantly, what happens when speculative positioning unwinds faster than physical demand can respond? Because those two systems operate on completely different timelines. One moves in milliseconds, the other moves in quarters and years. When they collide, you don't get balance, you get air pockets. This is where the real question emerges. Was this crash simply a painful but necessary reset after an unsustainable run? Or was it a trap? One where late momentum buyers were pulled in just long enough to provide liquidity for a much larger unwind? The article doesn't answer that, but it gives us clues. Raised margins, dealer hedging flipping direction, stop-outs cascading, liquidity tightening in London, Western flows driving volatility while Asian markets slept. Individually, none of these are shocking. Together, they point to a market that wasn't just overheated. It was structurally fragile, and fragile structures don't fail gradually, they fail suddenly. Here's what most people haven't fully processed yet. When speculation dominates price discovery for long enough, the eventual unwind doesn't just correct excess, it rewires behavior. Participants pull back, liquidity providers get cautious, volatility premiums rise, and even after prices stabilize, the market doesn't behave the same way again, at least not immediately. That's the part no chart will show you. And it's why this move matters beyond silver, because silver often acts as a stress amplifier. It reacts faster, and more violently, to shifts in liquidity, leverage, and risk appetite, which makes it a signal, not always a clean one, but rarely a meaningless one. So here we are, silver down sharply after a historic run, speculation still possibly unwinding, margins higher, liquidity tighter, fundamentals intact, but sidelined. The surface story is volatility, the deeper story is structure. And in the next part, we need to look at how that structure formed, why it became so unstable, and what this kind of unwind has historically led to in other markets. Because the real risk isn't what already happened, it's what happens if the flush isn't actually finished. Let's go one layer deeper now, because what happened in silver wasn't just a price event, it was a mechanics event. And mechanics are where markets quietly break. To understand why this unwind became so violent, you have to understand how silver was being traded before it fell. Not by miners, not by industrial buyers locking in supply, but by leveraged participants expressing views through futures and options. That matters, because leverage compresses time. It takes what would normally be a slow rebalancing and turns it into something urgent. When prices rise, leverage looks harmless, efficient even. When prices fall, leverage becomes unforgiving. Margins don't care about narratives. They don't care about long-term demand. They care about today's price. And when exchanges raise margin requirements into a falling market, they effectively shorten everyone's runway at the same time. That's when positioning starts to unwind synchronously. This is where dealer behavior becomes critical. In calm markets, dealers tend to dampen volatility. They hedge by buying weakness and selling strength. That provides liquidity when others hesitate. But Goldman's note highlighted a key inflection point. Dealer hedging flipped. Instead of absorbing pressure, dealers began adding to it, selling into weakness rather than cushioning it. Why would that happen? Because options positioning had become one-sided. When too many participants are positioned the same way, the hedging flows that normally stabilize markets reverse direction. The system stops acting like a shock absorber. It starts acting like a lever, and levers magnify force. This is a subtle but important distinction. No one had to panic for this to cascade. No one had to believe silver was suddenly worthless. The structure itself did the work. Stop losses triggered automatically. Margin calls forced exits mechanically. Hedging flows accelerated the move. Each step fed the next. That's how cascades form. And once they begin, the market doesn't ask whether prices are fair. It only asks who can still hold on. Now zoom out. Silver didn't rise 146% in 2025 because industrial demand suddenly doubled. That kind of demand shift doesn't happen that fast. What happened instead was narrative alignment. Inflation concerns, energy transition themes, distrust in currencies, precious metals as protection. Those ideas attracted capital. Then momentum took over. Momentum isn't irrational by default. It's a strategy, but it depends on continuous inflows. When inflows slow or reverse, momentum strategies all try to exit through the same door. That door was never very wide in silver. This is why comparisons to meme stocks aren't completely off base, but also shouldn't be taken too far. Silver isn't GameStop. It isn't a company with questionable fundamentals. The comparison is about flow behavior, not intrinsic value. In both cases, price became the message. Rising prices attracted more participants. More participants pushed prices higher. Eventually, positioning outran liquidity. At that point, the trade becomes fragile, and fragility doesn't announce itself until it breaks. Now let's talk about what this does next, not predictions, scenarios. Because markets rarely move in straight lines after events like this. One possible path is continuation of the flush. If speculative positioning truly hasn't been fully cleared, as Garg suggested, then volatility may persist. Prices can overshoot to the downside as remaining leverage is forced out. This doesn't require new bad news. It just requires existing positions to unwind. In this scenario, price weakness wouldn't signal collapsing fundamentals. It would signal unfinished deleveraging. Historically, these phases end not with headlines, but with boredom. Volume dries up, volatility compresses, participation thins. That's how speculative cycles usually exhaust themselves. Another path is stabilization with instability underneath. Prices stop falling, but they don't recover quickly either. Volatility remains elevated. Rallies are sold. Confidence takes time to rebuild. This often happens when long-term holders are still constructive, but short-term participants remain cautious. The market becomes range-bound, but worried, but tense. Silver has behaved this way before after violent moves. It's not dramatic, but it's psychologically draining. There's also a less discussed possibility. That silver's move wasn't just about silver. Remember the timing Goldman pointed out? Western flows, liquidity conditions, dealer behavior. Silver is often the first place stress shows up because it sits at the intersection of commodities, inflation hedging, and speculative capital. If risk appetite is shifting more broadly, if leverage is becoming more expensive or less welcome, silver can act as the early signal. Not the cause, the symptom. That doesn't mean other markets must follow, but it does mean this move shouldn't be viewed in isolation. Now, let's bring gold back into the picture. Gold fell too, but far less. That divergence matters. When gold holds relatively steady while silver collapses, it usually tells us the sell-off is not about rejecting precious metals as a category. It's about purging excess risk. Gold is less leveraged, more liquid, more institutionally held. Silver is where speculative energy tends to pool. So when stress hits, silver moves first and hardest. That's not new. But the speed this time was notable. Here's the part that deserves careful thought. When margin requirements rise and volatility spikes, some participants are permanently changed. They don't come back quickly. Risk models get updated, limits get lowered, committees get cautious. That doesn't kill a market, but it changes its character. Which means even if the fundamental case for silver demand remains intact, and there is no clear evidence it doesn't harder, price behavior may remain less forgiving for a while. Rallies may require more proof, pullbacks may come faster. That's the quiet aftermath of mechanical stress. So was this the biggest trap of 2026? That depends on what you mean by trap. If the idea is deception, someone intentionally luring participants in, the article doesn't to support that. What it does support is something more common and more uncomfortable. A structure that rewarded momentum for too long became crowded, and then reversed faster than most participants could adjust. No villains, no guarantees, just math, leverage, and human behavior interacting under pressure. The unresolved question now isn't whether silver has value. It's whether the market has finished repricing risk, because until leverage fully resets, price discovery remains noisy. And noisy markets are where narratives get loud, but clarity actually matters most. This wasn't the end of the silver story, but it may have been the end of that version of it. The version driven more by positioning than patience. And what comes next will depend less on headlines, and more on whether stability can return without excess leverage rebuilding too quickly. That's the real test.